everybody. Welcome to the Tortoise Quick Take podcast, and we're going to do a little special edition this time. Most of you know me. I'm Rob Thummel. I'm a senior portfolio manager here at Tortoise, and I'm joined by Hunter Wilcox. Hunter joined us a little over a year ago, actually a couple years ago, and he's been covering lots of securities for us and oil and everything. And what I think all of you need to know is obviously you all know James, Matt, and Brian and I, and collectively at Tortoise we have over 100 years of experience managing multiple economic cycles, multiple commodity cycles, but we are supported by guys like Hunter and John Price, and we have others on our team that are really up and coming, and we really enjoy their perspectives. And so today we're going to get Hunter's perspective on probably an event that everybody's aware of over the weekend, and obviously that is the Iranian attack, or the U.S. attacks on Iran, and then where we are today, specifically to the oil market. So Hunter, why don't you just get it up to speed? What happened over the weekend, and then we'll go from there.
Sounds good, Rob. So what happened over this past weekend? You guys probably know it's a pretty evolving situation, but just kind of a recap. On Friday, Trump talked about the Geneva talks being not too productive, and he was kind of disappointed with the end result. So he quickly said there'd be some action taken, and within 24 hours, Saturday morning, Israel and the U.S. struck Iran. They struck it very quickly. They took down a lot of military nodes. They took down some airfields, some drone and missile sites, as well as they took out senior Iranian leadership. Iran didn't really like this. They announced that they were going to be striking immediately, and they launched multiple strikes on Gulf Coast regions where a lot of the U.S. military bases were located. They quickly responded to that. Moving on to Sunday, a lot of vessels stopped passing through the Strait of Hormuz, which is that the choke point between Iran, which they can control. It's about 20 miles wide, so it's a pretty small strait. But Iran is kind of threatening that region right now, and a lot of vessels don't want to pass through it. So we saw vessels drop from 57 crude tankers and nat gas vessels on Friday down to 7. So the strait was effectively closed during this time frame, which has really resulted in the commodity market going crazy, because Brent today has now closed up about 7% from its Friday close and is now around $78, $79, and it's up 30% year to date because of this geopolitical risk premium coming in. And then also looking at LNG, the LNG market has really skyrocketed as Qatar announced that they're taking off their LNG production, which does about 20% of the supply for the total global LNG trade. So that resulted in TTF jumping up to 45 euros and is now up about 50% today.
So 20% oil production of the global oil supply goes through the strait, as you highlighted. 20%.
That's correct.
Of the global LNG production goes through the strait. So it's really important infrastructure, and I think that's really one of your major points is some of that infrastructure really wasn't damaged, but the ships weren't able to get through. For what reason do you think?
A lot of the reasons is just fears of potentially being striked, because just recently today, one of the officials of the IRGC came out and said that they would be striking any vessel that passes through there. So interest rates are spiking significantly, and in fact, insurance rates are jumping up very significantly. And March 5th, they said they're going to no longer be insuring vessels going through that area, so a lot of vessels do not want to traverse this dangerous water.
So much higher shipping costs, higher commodity prices. So where do we go from here? What do we think? What do we think is going to happen here? And let's just take both ends. Let's just talk about oil first. Where could oil prices go depending on what happens from here?
Yeah, that's a great question. Oil could honestly go up to $90 or even over $100 a barrel if we see the Strait of Hormuz being shut down for 2, 3, or 4 weeks because of that 20% of global crude passes through there. Should that happen, a lot of inventories would start drawing. You'd see a lot of offshore and onshore inventories drawing. And then this would really honestly crush a lot of that oversupply narrative everyone's been talking about, because balances would tighten up significantly because of that, and that is what would push up a lot of the crude commodity.
Has the Strait of Hormuz ever been closed?
No, it has not been ever closed before.
so that's good. How about natural gas? What do we think European natural gas prices? Do we have an idea of where those could go if Qatar, and maybe frame it a little bit about how important Qatar is to the global natural gas supply and the global LNG supply?
Yeah, Qatar is extremely important, as they do produce about 20% of the exports for the whole entire globe. If they are again no longer able to export LNG, you could see this 45 euro price go to 50, 60, or 70 if this keeps on going out, and it'd be very impactful, especially considering the fact that the U.S. LNG already is about 95, 96% utilized. There's not a lot of excess capacity that can go out there. So you're going to see a lot of prices just skyrocketing, and it's going to be pretty unaffordable for the EU and Asia to get most of the LNG.
Well, that's perfect. So we, obviously everybody knows us at Tortoise, we invest in energy equities. We've been investing in energy equities for my entire 2 decades here, and for me personally, 3 decades. This is a unique event, but obviously this doesn't happen very often. And so maybe you can just share with us how the equities respond today, and what did well, I guess really what did well, maybe what didn't do well today as a result of the events over the weekend.
Yeah, so the equities that did really good today, I would have to say, like the more so commodity-linked equities. So any type of LNG exporter that has that exposure to that spread between TTF and Henry Hub, those guys are doing really well because of the shutdown. Oil E&Ps and integrated E&Ps are also doing really well because they're very exposed to this crude oil commodity price that's up about 7-8%. And then finally, refineries are also starting to catch a little bit of a bid because today one of Saudi Arabia's refineries was striked, which will take off some diesel and jet fuel supply. So this will allow those margins to really expand, and the refiners will benefit from this.
Yeah, and that's actually an interesting observation. I actually would have thought that potentially refiners would have underperformed a little bit today because oil prices went up. Maybe the gas, we don't, in the U.S., I don't think anybody wants gasoline prices to go up anymore. So who's going to suffer potentially would have been refining margins. But as you highlight, because one of the largest refineries in the world in Saudi Arabia was hit, the perception of lower gasoline inventories globally that are available, I guess, pushed the need for more U.S. refiners to produce even more. Maybe what does this say about the U.S.'s ability to basically be energy net independent?
Oh, it's a great thing that we're energy net dependent because this is all going on in the Middle East and impacting EU and Asia, but the U.S. has no concern whatsoever on this front because a lot of our refiners run that heavier crude slate, so we are pretty much seeing minimal impact whatsoever because we have our own oil and we have a lot of our own net gas. So, and we're also a net gas exporter. Like Qatar shutting down is not an impact on us whatsoever because we are one of the largest global producers of LNG. So, largely we're in a pretty good place by being as solid as we are.
And what did natural gas end up trading at today in the U.S.? You remember? $3. I'll help you out on that because you remember a lot of things. You made some great points. The point is natural gas, to Hunter's point. Europeans, they're probably paying 5 times that. They're probably paying, $15, $16 per unit of consumption of natural gas.
Exactly.
The U.S., we're paying $2. I had the opportunity to cheat because I had some interviews earlier today that I had to look. Hunter didn't get that chance. But so they're paying 5, 6, 7 times more of natural gas than us. And to your point, the U.S. is net energy independent for natural gas. Actually, we have so much natural gas produced in the U.S. that we can export it. Maybe just to wrap things up a little bit, share, how was the U.S. able to be in this position to be a net energy independent for natural gas and to a certain extent net energy independent from an oil perspective?
Yeah, we ended up in this position because around 10 years ago we thought we were going to need a lot of nat gas coming in here. That's where Sabine Pass became very popular. We were expecting that, but then we had some pretty sizable discoveries of nat gas. The Marcellus is produces a lot, and then the GOR ratios in the Permian started increasing pretty rapidly as well. So we have a lot of nat gas that have been allowed us to then turn these into export facilities instead of import facilities. So that's kind of where we have some of the gas commodities, and then crude front, also the Permian just as a gift that keeps on giving. We keep on getting more and more production every single year. It was projected that it was going to be flat for 2026. A lot of E&P guys were saying the commodity environment wasn't looking too good, but they're going to continue. They're probably going to produce a little bit more if we see a sustained crude price level. So we have a lot of gas and we have a lot of crude that can keep driving a lot of our equities and E&Ps and midstream higher.
So I think what that says to me is, and that's a great answer, Hunter, I think what that says to me is, look, the U.S. shale industry and us in the U.S. Need to show a lot of gratitude to the U.S. shale industry and the energy industry because we become net energy independent and when we have significant events and geopolitical risks like we saw over the weekend, and we probably will continue to see, we'll be able to keep consumer prices lower and keep energy prices lower and do things like win this big global race for AI because of low energy costs. So Hunter, it's great to have you. I'm looking forward to interviewing a little bit more about other things, all energy. Hunter's a fantastic resource. He covers oil, he covers individual companies for us, and you'll hear more from him in our upcoming Quick Take podcast. And for everybody who's joining, thank you for joining us for this Quick Take podcast, and we look forward to talking to you soon.